So for today, we will talk about your notes and bands payable. So your notes and bands payable is almost the same with your notes receivable and investments in bands. So the concepts that you have learned before here in your assets section can be used in your liability section. So the notes receivable in your assets section, of course, is your notes payable, and your investment in bands is your bands payable. So let's talk about your notes and bonds payable by first having a recall on your different present value factors and how do we use them. Okay, so first, notes and bands. Notes, of course, is evidenced by a promissory note. Bands is evidenced by a band indenture. Unlike your accounts payable, of course, is only an open account. It is not evidenced by anything. However, your notes and bands are evidenced by a particular document. For notes, it's your promissory notes, and your bands, your band indenture. Notes and bands are normally the same. You need to pay a sum certain in money, so sum certain at a specified date. Okay, so they are the same. You need to pay a sum certain at a specified date. Their difference only lies as to what particular evidence or document have you signed. If it's a promissory note, that is notes, bands, band, indenture. But normally, bands, as you have learned before in your financial management, is used for your financing purposes more of rather than your notes. So if you want to have a long-term finance, normally you issue bonds. But for short-term financing, you use your notes. That's how they use your notes and bonds in actual practice. They issue bonds for financing, normally long-term, and if they need short-term finance, they generally issue notes. But they are the same. You need to pay a sum certain at a particular date. So that specified date is the due date of your notes and bonds. So let's have a review on your rules on your present value. Again, if you have unequal cash payments, we use present value of 1. If we have equal cash payments and the cash payment is made at the end, present value of ordinary annuity of 1. And if ever it is an equal cash payment and made at the beginning, present value of annuity due of 1. I know you already know how to compute for this present value factors. Normally, when I give problems, I don't give present value factors. It's up for the students how to compute for them, for you to practice your present value factors. And remember, you do not use only one particular type of uh, present value. So you can combine these items. You can combine present value of ordinary annuity with PV of 1, or PV of 1 only, and PV of annuity due of 1, and PV of 1. Okay? So remember, if ever it is an interest bearing, if it's interest bearing note, generally you need to compute two PVs, PV of principal and PV of interest. So if that is a term note or band, when we say term note or band, it is to be paid at a lump sum price. So lump sum, minsanan lang natin babayaran yung term na yan. So if ever it is a term note or band, how do we measure it? We get for the PV of principal and the PV of interest. The PV of principal normally is computed at PV of 1, and then the PV of interest is to be computed at PV of ordinary annuity of 1. Okay, if that is term. But if that is a series or serial, meaning the note or the band is to be paid at installment. Okay? So the principal is to be paid installment, meaning we have principal repayments. The main difference between your term band and your serial band or term note or serial note is that in your term, there is no principal repayment every year. However, in your serial, since it is considered series or serial, you need to pay installment. Okay, you need to pay installment. So in your series or serial, your main problem here is that if ever you have equal principal repayment or unequal principal repayment. If you have equal principal repayment, how do we compute for your uh, carrying amount or your issue price? So if you have equal principal repayment, you get your PV of principal by using present value of ordinary annuity or annuity due, depending whether you will pay at the end or at the beginning of the period. And then to get for the PV of interest, we use present value of 1. Take note, since they have equal repayment or principal repayment, interest payment differs from year to year. Okay? So from year 1 until the end of the term of that particular note or band, the interest payment will differ. Next, if we have unequal principal repayment, for PV of principal, we use PV of 1, PV of interest, we use PV of 1. Take note again, your interest payment here differs from year to year. Sir, why do we use your PV of 1 for principal and for interest we still use PV of 1 here? So take note in your installment here, we have equal principal repayment. Since your principal repayment is equal, so meaning your principal will have equal payments. So equal cash payments, what do you use? PV of OA and PV of annuity due. Next, we have your PV of interest. We say your interest payment differs from year to year. What if different ang ating cash payments? We use PV of 1. Next, unequal principal repayment. Since your principal is unequal as to payments, what present value factor will you use for unequal cash payments again? PV of 1. That's why here we use your PV of 1. Next, for PV of interest, we say your interest payment differs from year to year because it is dependent on your principal. Since your interest will differ from year to year, it means we have unequal cash payments. We use PV of 1. Okay, so a quick recap again. If you will have unequal cash payments, we use PV of 1. If you have equal cash payments, you use OA or annuity due. Okay? So why in our term we use your PV of principal PV of 1? Since your principal here does not change, does not change. So it means you will pay it once only. You will pay it once only. There's no series of installment. Then you use unequal cash payments, PV of 1. Sir, why in our interest we use PV of OA? Because here your interest does not change. Since your principal does not change, your interest does not change. Because remember, interest is equal to your principal times rate. Therefore, guys, if principal will not change, your interest will not change. But if principal will change, your interest will change, just like in this one, because we need to pay principal, right? Since we pay your principal will change. Since your principal will change now, your interest will also change. Hence here, guys, remember here in your term, your interest will not change because your principal will not change. There is a direct relationship between your interest and principal. Once principal changes, interest changes. Once principal does not change, interest does not change. Okay? So those are the rules under your present value that you have learned before in your financial management. Okay? So let's have a quick recap on your notes. For your notes payable, we have either short-term or long-term note. So when can we say it is short-term? When can we say it is long-term? It is a short-term note again if the due date is less than or equal to 12 months. It is considered a long-term note if ever the issuance is or the due date is greater or equal to 12 months. Guys, what we look into in your less than or equal to or more than 12 months here is the due date at issuance. Okay? So you check the due date at issuance if ever it is less than or equal to 12 months or greater than 12 months. So if ever at the time of issuance it is less than or equal to 12 months, then it is a short-term note. If that is a short-term note, it can either be interest-bearing or non-interest-bearing. When can we say again a note is interest-bearing? If the note bears or has interest rate is stated on its face. Okay? So if there is an interest rate is stated on the face of the note, it is considered interest bearing. But if there is no stated rate on the face of the note, it is considered non-interest bearing. But for short-term note, whether interest bearing or non-interest bearing, we initially measure them at face. Sir, why? Because here in your non-interest bearing, generally, you need to measure it at present value. But since it is short term, and what will happen in case it is short term, the present value or the discounting will become immaterial. Remember this one as a concept in your financial management that in case the term is so short, the discounting is immaterial because the cash flows during that particular period will not automatically change. Unlike your cash flows in case we have a long-term note. Because it is long-term, it is presumed that during that particular term, the note or the cash flows will differ from time being. So from the time you issued it up to the time it is due, normally what happens because of the discounting, the value of the peso today will differ on the value of the peso on its due date because it is too long. However, in short term, the value of a peso today and the value when it is due already, since the particular dates is too short, the change in the peso or change in the purchasing power is immaterial. Therefore, discounting is immaterial. So generally, in your non-interest bearing note, short term, it is still measured at face. How do we subsequently measure it? Generally, we do not subsequently measure a short-term note. Why? Because it will always be paid ahead of time. So, you don't normally default on a particular note. But if you have defaulted, we use your debt restructuring, which we will discuss soon. So unlike in your notes receivable, when you default in note receivable, it becomes accounts receivable. In a notes payable, when you default your liability, it does not automatically become accounts payable, but you enter into a restructuring program. Okay, so next, long-term note. For long-term note, it can either be interest again or non-interest bearing. So if it's interest bearing, initially, you need to look whether it is substantially different or not substantially different with the market rate. So what you will compare here is the stated rate on the note versus the market interest rate. If the difference is at least 5%, we say it is substantially different. If it's substantially different, you measure it at present value. If it's not substantially different, you measure it at face. Okay? So just the same rule with your long-term note in your receivable. Subsequently, amortized cost. Guys, remember this one. Under PFRS 9, the subsequent measurement of your financial assets and financial liabilities generally is your amortized cost. Therefore, if the problem is silent, always amortize cost. So use effective interest method. The use of straight line method, uh, you will only make use of it once the problem tells you to use a straight line method. So the general rule is that always use your amortized cost using effective interest method. Okay? So interest bearing, you check the stated rate to the market interest rate. If the difference is at least 5, it is considered substantially different present value. If it's not substantially different, you use the face amount. So subsequent measurement, you use your amortized cost. Next, for non-interest bearing, initially you measure it at your present value. Since in non-interest bearing, we assume that inside the face amount of the note, on the face amount of the note, it bears both the principal and interest. So we just need to get for the present value to show the value of our principal. And whatever is left is considered your interest. Subsequent measurement, amortized cost. So in your short-term and long-term notes payable, whatever you have learned in your notes receivable as to its measurement is still the same under your notes payable. Because remember, what is recorded in the asset, what is recorded on the other entity must also be recorded on another entity. So the asset of one entity is the liability or equity of one entity, or the liability of one entity is the asset of one entity, or the equity of your one entity is the asset of your one entity. As you have learned before in your basic accounting equations. So whatever is the notes receivable measured here in your asset can also be the amount of your liability as to your notes payable. So the same rules. We go now to your bands payable. In your bands payable, the initial measurement here differs as to the initial measurement of a band receivable or your investment in bands. Generally, under your PFRS 9, your financial assets are measured at fair value plus transaction cost. But in bands payable, if ever we have a transaction cost, we deduct that. Because remember, if a particular person paid an extra amount to purchase that particular asset, the transaction cost is considered a direct cost. So in an asset, it is to be added. However, in a balance payable, since this is a liability, we deduct the transaction cost. This one, your transaction cost will not increase your economic benefit, but is considered to be a reduction of your uh, liability. So your transaction cost treatments in your liability is considered a reduction. So it is like a considered repayment. While in your asset, it is considered an additional cost because it is considered a directly attributable cost. Sir, why do we not add it? So if you incur transaction costs, does that mean there will be an increase on your liability? Of course not. Your liability will still remain the same. However, the treatment because of your transaction costs as if it is considered a payment. That's why we deduct them. So take note, in an asset, generally transaction cost is added, but in your liabilities, all your transaction costs are deducted. It does not increase your liability, but rather decrease your liability. It's so absurd in case that you have a transaction cost and then suddenly it will increase your liability. So the treatment will always be a reduction. Subsequent measurement, amortized cost. Remember, using effective interest method. You will only use your straight line method once the problem tells you. So quick recap again on the difference of your issuance price and face amount. If the issuance price is equal your face amount, it is considered at face. If the issuance price is less than the face amount, it is considered at a discount. If the issuance price is greater than the face amount, it is considered at a premium. Now, as to the relationship of your effective interest rate and nominal rate, if the effective interest rate and nominal rate is equal, it is considered at face. If the effective interest rate is greater than the nominal rate, it is considered at a discount. Effective interest rate is less than the nominal rate, it is considered at a premium. So whatever again you have learned before as to your issue price and face amount and EIR versus nominal rate is the same. So whatever you learned before in your receivables and your investments, the same pa rin yung rules natin dito. Okay? So balance payable presentation. So when can we say it is current? When can we say it is non-current? It is current if there is a portion currently due, and it is non-current if it's still not currently due. So generally, as we said, we have either term or we have either series. So in term, it will only be current if it is within 1 year. Okay, so the payment is within 1 year. So for example, we have a 5 year band, 5 year band. It will only become current at its fourth year, end of fourth year. Okay, so current lang siya at the end of fourth year. So again, term band, it will only become current within 1 year. Non-current if it is not within 1 year. Okay, it is considered non-current if it's not within 1 year. For series, the current is the total amount of amortization. So this is equal to your principal repayment plus or minus your amortization for the interest. Okay? So for series, the current is the total amount of amortization. That is your principal repayment plus or minus the amortization for the interest. So normally this is the carrying amount, right? And then we have here your amortization subsequent year, and then the carrying amount the subsequent year. This total carrying amount is equal to these two items. The amortization here is the current portion. The non-current portion is the carrying amount on the subsequent year. Okay? So carrying amount this year less amortization next year is the non-current portion of the series. Okay. So current, the total amount of amortization, that is principal repayment plus or minus the amortization for the interest. So kumbaga, ito yung current amount. So amortization table yan. Let's say year 1, year 2. So may carrying amount yung year 1 na yan. Yung current dyan, yung amortization ng year 2. Yung non-current dyan, yung carrying amount naman ng year 2. Okay? So ganyan pagka-series. Pag term, current, pag within 1 year. Non-current, not within 1 year. Yung buo. Sa series, hahatiin mo siya. May current at saka non-current portion talaga. Yung current niya, it is the amortization, and the non-current is the carrying amount. Okay? Okay, that's for bands payable presentation. Let's have some examples. So this is an example of a term band at a discount. So when we say term again, it will be payable at a particular due date. So you will not pay it in installments. So on January 1, year 1, ABC issued 1,000,000 10% band to yield 12% interest. Interest is due every year and principal is due after 3 years. So sabi natin, pagka term yan, ang gagawin mo, yung PV of principal, we use your PV of 1. PV of principal, we use your PV of 1. And PV of interest, we use your PV of OA of 1. So since we have here 3 years term and our yield rate is 12%, we use your 12% as our interest rate. So to get for the PV of our principal and interest, so we have 0.7117 for PV of 1, N is equal to 3, I is 12%. For PV of interest, we have 2.40183, this one, N is equal to 3, I is equal to 12%. And then we get the total amount that is 951,963.37. Okay, so we place that as our recurring amount on January 1, year 1. To get for our interest payment, how to get for interest payment again? That is equal to your fees or your face amount less any principal repayment multiplied by your stated rate. Our stated rate here is 10%, so that is 1 million times 10%. So as you can see, guys, the interest is the same throughout the periods. Why? Because again, we said that if ever it is term band, the principal will remain the same, therefore the interest will remain the same. Next, to compute for our interest expense. Our interest expense is equal to your carrying amount multiplied by your effective interest rate or yield rate. Our yield rate is 12%. If we have 951,963.37 here, we multiply it to 12%, we will get 114,235.60. So the amortization will become 100,000 less 114,235.60. We have 14,235.60. Actually, interest payment less interest expense less principal repayment will give you your carrying amount. So what we do normally, if ever in your asset, what we do is your principal repayment is on this particular side so that the total amortization dire-diretso na lang. Okay? So, di ba, interest payment less interest expense less principal repayment, that is your total amortization. But in this particular example, I want to show you the amortization of the interest per se. So, to amortize the interest, 14,235.60. So to get for your carrying amount is equal to carrying amount previous year minus your amortization. So your carrying amount previous year is 951,963.37. Your amortization is negative. So 951,963.37 minus negative 14,235.60 magiging 966,198.98. And you will continue computing for that until year 3. So in this particular example, as of December 31, year 1, it is still non-current. Value 966,198.98. December 31, year 2, value 982 142.86. Current, non-current, it is already current because it will now be due by the end of year 3. And then, finally, 1 million pesos and the repayment of 1 million. Remember, once the bond is due, that 1 million, we need to pay it already, 1 million pesos. So, term at a discount. Next, term at a premium. On January 1, year 1, ABC issued 1,000,000 10% bond to yield 8% interest. So when can we say it is a premium or discount? Again, we look into the stated rate, 10% band, and the yield rate, 8%. So the stated rate is greater than the yield rate here. Therefore, we have a premium. A while back, we have a 10% band, and a 12% yield rate. So our stated rate is lesser than our yield rate, therefore discount. Okay, so let's take a look into this example. So since it is a term band again, to compute for your term band, you just need to get for the PV of principal at PV of 1, PV of interest at PV of ordinary annuity of 1. So our N is 3 because the period of the bond or the term of the bond is 3 years, and our interest rate is the yield rate, which is 8%. So we just need to compute for the present value factors. We multiply them to their amounts. We will get 1,051,541.94. Notice, guys, in your PV of interest, do not forget, you just need to get for the fees first. You multiply to your interest rate. Okay, so that's why we have here 1 million times 10%. Once we get the carrying amount of the bond, we have 1,051,541.94. We can amortize that already. So in your interest payment, again, that is equal to your face amount less any principal repayment multiplied by your stated rate. For your interest expense, that is equal to your carrying amount multiplied by your yield rate or effective interest rate. Amortization, interest payment less interest expense. Now, for your carrying amount, notice here, to compute for your carrying amount less amortization. So here, negative, less, since this is positive, so carrying amount less 15,876.64 will give you 1,035,665.30. Do it again here, 100,000 less 82,853.22 will give you 17,146.78. Therefore, 1,035,665.30 less 17,146.78, we have 1,018,518.52. Next, Example, cereal at a discount. So here we have a cereal type of a bond. So on January 1, year 1, ABC issued 3,010,000 bond to yield 12% interest. Interest is due every year and the principal is to be repaid in three equal annual installments. So I told you if ever the principal changes, the interest changes. That's why in your interest, we computed three types of interest. So take note to compute for your interest that is equal to your face amount less principal repayment multiplied by your interest rate. That's why here we have here your face amount multiplied by interest rate because there is no principal repayment. On year 2, face amount, we remove your principal repayment because we paid on year 1. On year 3, we have your face amount, we deducted to 1 million because of the two principal repayments in year 1 and year 2. Okay, that's why we got 300, 200, and 100,000 as interest. Okay, next, for the PV of principal, since the principal here will be paid in equal annual installment, we use now PV of ordinary annuity of 1. So this is the amount of our present value. So 3 million divided by 3 times 2.401 blah blah. Sir, why did we divide it to 3? Because we need to make or get your 3 equal annual installments. So 3 million divided by 3 years, how much is the annual installment? 1 million per year. That's why we need to divide that by 3. Also, again, your interest, we computed that way because since the principal changes, our interest amount changes. So as you can see, on the first year, 3 million only. In year 2, we deducted 1 million because we have a principal repayment on year 1 of 1 million. On year 3, we already have a principal repayment on year 1 and on year 2. That's why we deducted to 1 million pesos. Okay? So once we computed our present value, we have here 2,903,05.21 as our carrying amount. Once you computed your carrying amount, you compute your interest payment. We already done that. Interest expense is equal to your recurring amount multiplied by your yield rate or effective interest rate. So 2,903,05.21 times 12% interest. And then amortization is still the same interest payment less interest expense. That is the amortization. To get for your total amortization, we have your principal repayment and your amortization get the net. So we have 1 million and then 48036.63. 1 million less 48036.63. We have here 951,963.37. So 2.9 less the total amortization, 2.9 million, 29,305.21 less 951,963.37 will give us 1,984,341.24. So on January 1, year 1, what is the total carrying amount? The total carrying amount is 29,305.21. I told you if that is a serial band, we get the current and non-current portion. The current is the total amortization, 951,963.37. The non-current is the carrying amount next year, 1,948,341.84. How about on December 31, year 1? What is the carrying amount? 1,948,341.84. To get for the current portion, get again the net amount of this one. So 1 million less 33,801.02 will give you 966,198.98. Or you can get the difference of this one. So 1,948,341.84 less 982,142.86. We will get still 966,198.98. Okay? So the current therefore is 966,198.98 and the non-current is 982,142.86. On December 31, year 2, what is the total carrying amount? 982,142.86. That is now our current. Our non-current will be 0 kasi 0 na yan. Okay? So, ganun yung gagawin natin pagka-series. So, from our carrying amount, hatiin natin yan. Yung total amortization, yan siya. Or, kung gusto nyo, kunin nyo rin lang din yung difference nito. Kunin nyo lang yung difference ng dalawang yan. Ang makukuha nyo lang din naman is 951,963.37. Okay? Tapos, yung carrying amount next year, na yun naman yung non-current. Okay? Serial times current and non-current portion, and how do we compute? Once you know how to prepare this amortization table, it will be easy for you because you will just be asked what is the interest expense, what is the carrying amount. So you will just pick. So if the question is, what is the interest expense on December 31 year one? So get December 31 year one. What is the carrying amount December 31 year two? This one. What is the current portion December 31 year one? Current portion December 31 year one. Non-current portion December 31 year one. Diba? So you just need to prepare your amortization table. Once you prepare correctly your amortization table, it will be easier for you to answer questions relating to this one. Of course, that it starts with the proper usage of your present value factors. So if you already forgotten about your present value factors, please review them. Please review them. Next example, serial at premium. So a while back, we have your example term at discount, term at premium. Next, we have your serial at discount. And now we have your serial at premium. So on January 1, year 1, ABC issued 3 million, 10% bond to yield 8% interest. Interest is due every year and the principal is to be repaid in 3 equal annual installments. So the initial measurement is your issue price. So to compute for your issue price, take note, since it is again serial, the amount of our interest changes. Interest changes, that's why we computed 3 interest here. So to compute for our PV of principal, we still use PV of OA. And then PV of interest, we use your PV of 1. Now our interest rate is 8% because that is our yield rate. So once we computed all of our present value, we will get 3105,725.75. So 3105,725.75 we have here. We amortize that again. So to amortize that, we have your carrying amount. Your interest payment is equal to, again, face amount less any principal repayment times your stated rate. Your interest expense is equal to your carrying amount multiplied by your effective interest rate or your yield rate. Amortization, interest payment less interest expense. Total amortization, we have your principal repayment plus amortization that will give us your total amortization. And then your carrying amount, that is equal to your carrying amount previous year less your total amortization. Okay, so how much is the total amortization on year 1? Mas madali to kasi mag-add lang tayo, di ba? 1,051,541.94. Ito naman, 1,035,665.29. Last one, 1,018,518.52. Okay, so again, if on January 1, year 1, what is our carrying amount? 3105,725.75. What is the current and non-current portion? Current niya ito, non-current niya to, di ba? So current, 1,051,541.94. Current, so sa non-current naman, 2,054,183.81. December 31, year 1. So our carrying amount now is 2,054,138.81. What is our current portion? Ito naman, 1,035,665.29. Non-current portion, 1,018,518.52. How about on December 31, year 2, what's the carrying amount? 1,018,518.52. Current portion, this one, 1,018,518.52. Non-current portion now is 0. Okay, so that's how we present them if ever it is series or term bands. Do not forget your present value factors and the preparation of an effective interest method amortization table. Once you know how to prepare these items, it would be easier for you to answer problems relating to notes and bands. Next, we talk about your straight line method of amortization. What we talked about a while back is your amortized cost amortization. Now we have your straight line method. So in your straight line method, your discount or premium will be spread over the life of the band. So generally, you just need to get for your discount or premium, you divide it to your life. Okay, you divide it to your life. So what is the effect of your discount? Increases interest expense and your premium decreases interest expense. So once it increases your interest expense, do not forget to add it on your cost of your interest expense. And then for your premium, it decreases your interest expense. Okay, so you already know the effect of a discount or a premium. However, I just need to place it here for us to be reminded on the effect of a discount and premium on a straight line amortization. You know here that in your amortization, this is a premium, right? This is a premium amortization. If this is the interest, you deduct that, so your interest expense was decreased. O, di ba? This is your interest. This is your amortization. You deduct that, your interest expense decrease. This one naman, your interest payment. So 300,000. And then we have 48,063.63. So you deduct 300,000 to negative 48,036.63. We have 348,036.63 as interest expense. Okay, so in your discount, it increases. In your premium, it decreases. So that's why here, discount increases, premium decreases. Okay, so it's still the same effect. So just a reminder on the effect of your discount and premium on your interest expense. So let's have an example. ABC company issued 100,000 bond for 0.96. The bond is due after 4 years. Use straight line amortization. So if we amortize that, we have here 100,000 times 0.96. We have 96,000 pesos. We have 96,000 pesos. So if that is 96,000 pesos, guys, then we have 4,000 pesos discount. 4,000 pesos discount. So since 4 years yan, divided by 4, so we have 1,000 pesos amortization. So let's say this is 10%. So let's say it is 10%. So 100,000 times 10%, this is our interest, 10,000. Since you have a discount of 1,000, what is the effect again? It increases or does it decrease your interest expense? So take note, we said a while back that your discount increases, your premium decreases. So since this is a discount of 1,000, if initially we have 10,000 interest, we add 1,000, we have 11,000 interest expense. Dito naman, premium siya. So 100,000 times 105, so 105,000. We have here 5,000 pesos that is considered premium. We divide it to 5. We have 1,000 amortization per year. Okay? So madali lang to. You just divide it over the life. Yun yung equal amortization niya. Straight line. So para siyang straight line method ng depreciation, straight line amortization. So if ever the EIR is not given, take note ang sabi natin. If in case use your effective interest rate or effective interest method. unless the problem tells you use a straight line method. So laging effective interest method. If the EIR is not given, you interpolate, you get the PV less the PV of lower rate divided by the PV of higher rate less PV of lower rate. That is for interpolation. But generally, we do not use your interpolation kasi mas mahirap pa siya. What we do really is a trial and error method. So how does your trial and error method works? So based on the stated rate, based on your stated rate, you know if it's discount or it is premium. So you know now the relationship of your yield rate. So for example, 10% yan. Mag-try ka ng higher rate, let's say 15% para lang makuha yung present value. So we use trial and error. Gumagamit tayo ng iba't ibang rate rather than an interpolation as a whole. So let's try to answer your activity. So on January 1, 2017, Bain Company issued 4 million face value bonds with stated rate of 12% and a term of 5 years for 89.94. To compute for the sorry, to compute for the issue price of the bonds, we have 89.94% multiplied by 4 million pesos. So our issue price is equal to 3,597,600. Okay. So if we try to interpolate, if we try to interpolate 3,597,600, how do we do it? Okay. So we try it by getting higher rates kasi yung stated rate natin dito, yung face amount natin is 4 million. And then our carrying amount is 3,597,600. So face amount is greater than carrying amount. So we have a discount. So that is a discount. The stated rate is less than your effective interest rate. So what do? We make use of a higher rate. So we try, let's try 14%. Get the present value using 14%. So 1.14, 5 years. Did you get 3,725,353.52? Okay. So higher pa. Let's use 15%. So we get 3,597,741.38. Okay. So it's almost 15%, right? It's almost 15%, but we need to reduce it by the amount. So we have your 3,597,600 and 3,597,741.38. So we need to get the value based on 3,597,600. So we need to adjust that on a particular percentage. So we have 741.38 and 600. So our adjusted interest rate is now 15% or 15.07%. I don't know what you use here. Is it 15%? Because if in case magkakaiba tayo ng sagot, I use the whole rate here. I use 15.07% because of the difference on these amounts. Okay, sige. If we try to use 15%, if we use 15%, your interest is equal to 3,597,600 times 15%. Your answer should be 539,640. If you use 15.07%, the actual rate for this amount, because 15% is this one, 15.07 this one. So 3,597,600 times 1507, we have 542,158.32. So we have really a difference in case. I'll look into this one in case you use 15% rather than 15.07. Letter C, Carrying amount of the bond liability on December 31, 2017. So you need just to amortize it for one period. So you just need to amortize it for one period. So 3,597,600 plus 5,396,40 less our interest rate of 480,000. Sir, how did we get 480? So 4 million times 12% is 480,000. So let's answer 3,597,600. We have here 3,657,240. Next, for our 15.07, if in case you use 15.07, so we have 542, 3,597,600 plus 542,158.32 less 480,000. So 3,597,600 times 1.1507 less 480,000. 3,659,758.32. Okay? So guys, in case if in case the problem is like this, you get the whole interpolated amount rather than a different amount. So you just need to account for the difference. So this is our answer. Issue price 3,597,600. Interest expense, it depends whether you use the 15% rate or the 15.07% rate. So ayan naman yung ating carrying amount. The problem with these types of problems, of course, is for you to get the proper interest rates. Once you don't get the proper interest rates, then magkaka-problema talaga kayo sa computation. However, for our quizzes, since it is multiple choice, it will be easier for you to know whether you use the all rates or all the decimal points, or you will use only the full decimal point or 15% just like a while back, or 15.07% for a full decimal place. Okay? Kasi makikita nyo naman yun sa choices. Pagka medyo malalayo yung mga choices as to the answers, mas madali ninyong makukuha yung tamang sagot. Just take note, do not use your full interpolation, but rather use na lang the trial and error method based on the rules of your effective interest rate as the stated rate, your face amount as to the issue price. To here, our issue price, Electro Company issued 2,000,000 10% 5-year term bonds for 1.125. So sabi natin that is equal to your fair value less transaction cost. So our fair value is 2,000,000 times 1,125 less transaction cost of 90,292. So our issue price therefore is 2,159,708. So here we have a premium. Why? Face amount is 2 million. Issue price is 2,159,708. If there is a premium, how do we compute for our interest rates? Our interest rates must be lower. So effective interest rates must be lower. So we try lower rates. If this is 10%, let's try 7%. Let's try 7%. It is 2,246,011.85. Let's try a lower rate, 6%. 2,336. Let's try a higher rate than 8%. 1.08 less 5 years. So we get 2,159,708. 8.40. Okay, so our answer is 8%. So if that is 8%, our interest expense therefore is equal to 2159,708 times 8%. We have 172,776.67. Carrying amount, you just need to amortize it for 1 year. So we have here 2159,708 point 2159,708, and then you add the interest 172,776.67 less the interest payment 2 million times 10%, so 200,000. So our carrying amount therefore is equal to 2159,708 times 1.08 plus 172,2159,708 times 1.08 is 200,000. We have 2,132,484.64. 2,132,484.64. Okay. So guys, here in case we have differences again on your rates, I look into it. This is for our second problem in your assignment, electro company. Okay, so remember guys, trial and error rather than purely interpolation. Because in interpolation, you still need to compute for different present value and then later on interpolate. Here in your trial and error, pag nasertehan mo yung rate, yun na siya. Kesa formula ka pa. So dito nasertehan natin is 8%. So next, what if we have a bond with issued accrued interest? So what do we do? Your bond issue price less the accrued interest, that is the carrying amount of the bond. The bond issue price, this is the total cash to be received. Okay, take note the accrued interest will form part of your payable. So your CA of the bond will be decreased by the accrued interest. So when can you say that your bond is with accrued interest? So it's either issued at interest dates or issued in between interest dates. So let's say your interest dates is January 1. If you issue that on January 1 or December 31, so it is issued at interest dates, no problem. But if it's issued in between interest dates, so let's say you issued it on July 1. So January 1 dapat, pero na-issue mo on July 1. So we have 6 months of accrued interest. So the 6 months of accrued interest should be reduced, or should reduce our bond issue price to compute for our carrying amount of the bond. Take note, there is a bond with accrued interest if it is issued in between interest dates. Or in between interest dates here in our example, so January 1 dapat ang ating interest. You issued on July 1. You issued on July 1, so you have 6 months difference. That 6 months is considered 6 months accrued interest. You need to deduct it. Okay, so let's try to answer number 3 of your activity. On June 30, 2017, Leeds Company still sold to UI Company 1,000,000 8% 5-year term bonds. The bonds were dated January 1, 2017. Interest date is every December 31. The total issue price was to give it a yield of 6%. So first, we need to get for the total yield of our uh, total yield rate of 6%. So here, what we need to do is, since the issue price will yield to 6%, this should be our face of the, and this is our recurring amount of the bond. So let's compute using 6%. So 6, how many years? 5 years times plus. So 1,084,247.27. Since this is June 30, you remove pa January 1 to June 30. So we need to amortize for 6 months. So 1,084,247.27 times 6% times 6 over 12. And then 1 million times 8% times 6 over 12. So 7,472.58. So our carrying amount, 1,084,247.27 less the amortization, we will get 1,076,774.69. So this is the CA of band. If CA of band is already computed at 1,076,774.69, and then we have here accrued interest, and then we have here your total cash. So let's compute for our accrued interest. That is 1 million times 8% times 6 over 12. 40,000. So how much is our total cash? 176,774.69 plus 40,000. We have 1,116,774.69. So our total cash is 116,774.69. Take note, what is given here again is the TA of the band, which should yield a 6%. So our TA should be this one that will yield 6%. Sir, why do we need to amortize it for half year? So, di ba dito napansin nyo nag-amortize tayo ng half year? Kasi June 30 yan. Tapos January 1. So, merong 6 months. Okay? May 6 months. So, ingat kayo pagka ganito yung problem. Also, amortize. So here we have 1,076,774.69 as our carrying amount of bond, and our total cash is 1,116,774.69. Interest expense in 2017. So the total interest expense is equal to 1084. No, it's only 1,084,247.27 times 6% times 6 over 12. Sir, why do we need to multiply it to your 6 over 12? Because again, guys, half year lang, half year lang. Kasi yung half year nandito na, half year lang dito from June to December. So 1,084,247.27 times 6% times 6 over 12 will give us 32,527.42. Carrying value of the bonds at the end. So the carrying value of the bonds, 1,084,247.27 times 1.06 less 80,000. We have 1,069,1 1,069,302. 1,069,302.11. In your interest expense, alam nyo naman na yan, 1,069,302.11 multiplied by 6%. 64,158.13. Okay, that's it for accrued interest. In case may accrued interest, take note, pag ang total cash, total cash price, normally that is the bond issue price, okay? You deduct the accrued interest. Sir, bakit dito? Dito kasi, ang binigay is, kailangan yung matitira daw dun sa bond is mag-yield ng 6%. So ito, yung mag-yield ng 6%. So you need to work back to get for your total cash price. Next, retirement of bonds. If there is a retirement of bond, at the date of maturity, there is no gain or loss. but before date of maturity, there is a gain or loss. In a retirement, generally, we need to compare the retirement price to the carrying amount. If the retirement price is greater than the carrying amount, loss. Retirement price is lesser than carrying amount, we have a gain. Okay, let's have an example. So on January 1, year 1, ABC issued 1,010,000 bond to yield 8% interest. Interest is due every year and principal is due after 3 years. So we have here already your amortization table. So compute the gain or loss, assuming that the bond is retired on January 1, year 2. So January 1, year 2, yun yung December 31, year 1, di ba? 1035665. So this is now the carrying amount. You just compare the retirement price to the carrying amount. So in the first one, retirement price is 900. Our carrying amount is 1,035,665.30. So retirement price is lesser than carrying amount. We have a gain. Sir, bakit gain? Ito yung utang natin. Ito yung utang. Ito lang yung ibabayad mo sa utang. So, nakamura ka dun sa bayad mo sa utang. Since nakamura ka sa bayad mo sa utang, meron kang gain, 135,665.30. On the second one, babayaran mo yung utang mo ng 1,050,000. Ang utang mo lang dapat is 1,035,665.30. Nakamura na pamahal ka. Therefore, we have a loss. 1,050,000 less 1,035,665.30. Our loss therefore is 14,334.70. Take note on your gain or loss in your liability. There is a gain if your retirement price is lesser than your carrying amount. There is a loss if the retirement price is greater than the carrying amount. Because again, the carrying amount is your liability and the retirement price is the amount you need to settle that liability. So dito nakamura ka, kaya may gain. Dito napamahal ka. Ito lang yung utang mo, binayaran mo ng mas mahal, you have a loss. So that's it for your notes and